Hey, hello, everybody. Thank you for joining us and happy Tuesday to everybody. Hope you all have been enjoying the World Cup. Hope all you Americans out there enjoyed the 4th of July as much as I did. Did you have a nice 4th, Stoffel?
Yeah, it was great. It was a little bit overcast, but it was nice.
We had extreme heat here in the Northeast, so the beaches were absolutely packed. But enough with that. Mr. Stoffel, what are we talking about today?
Hey, we are talking about a stock that Jensen Huang recently said could be the next trillion-dollar company.
Trillion.
And let me tell you something. That actually means something for it. It is Marvell Technologies, not Marvel Comics, Marvell Technologies.
MRVL. This is the stock that we are talking about today. And on this deep dive, we're going to be taking it through the Simplifier 7 framework. We want to know, and as Stoffel said, Jensen Huang recently called this company the next trillion-dollar business. Oops. But do you guys own this stock? Let us know in the chat if you own Marvell Technologies stock. Now, Stoffel, we like to think through the difficulty level with analyzing businesses. Some companies are easy to analyze, restaurants and retailers. Some are medium difficult to analyze, marketplaces, social networks. Some are hard to analyze, and some require a PhD in accounting to really deep dive into them. Where would you rank this company?
I wouldn't say this is PhD, but I also wouldn't say that it's as simple as Netflix. It'd be like last week. It'd be hard and then maybe 2 scooches to the left between medium and hard.
I think that is a completely fair assessment there. So do we have any shareholders here?
We do. We've got some shareholders, but we've got a lot of people that don't own it. As of right now, this is not a stock that I own. How about yourself, Mr. Froldy?
I do not. I mean, this company wasn't even on my radar at all until a few weeks ago. And Jensen really helped to put it on my my radar here. All right, so here we have Stock Simplifier loaded, Marvell Technologies. We're going to load it up. And remember, Jensen just called this a potentially trillion with a $T company. Look at the market cap today.
That's a 5-bagger.
$200 billion market cap today. Jensen predicted this is going to be a $1 trillion company sometime in the future. All right, so let's see what the heck it does. So first off, look at this chart. Basically flat to the market. I bet if we go even longer. Yeah, this company came public in 2000. It
wasn't even market beating until the last. I mean, it's been market beating before, but until this year,
yeah.
I mean, really, it's been market matching.
And it was really in March that this company really started to take off. All right, this is a semiconductor company. The mission to accelerate the future of data infrastructure through semiconductor innovation. All right, so what does this company do? Marvell designs chips for the invisible connective tissue of AI data centers. While NVIDIA gets the headline for its training chips, Marvell supplies the custom silicon.
That's a keyword, custom silicon.
CPU clusters communicate. The optical DSPs that move data between racks at speed, and the networking switches that manage traffic across the data center fabrics. It's fabless. It outsourcing its manufacturer to Taiwan Semiconductor and Global Foundries. So it's a chip company that helps data centers run.
And I would say that custom silicon part is important. If you take away Broadcom's software that it has gotten through acquisitions, it's very similar to Broadcom.
Okay. Similar vein as Broadcom. Data revenue surged 46% to $6 billion in fiscal year 2026, lifting total revenue to $8 billion. Okay, so 6 of the $8 billion is related to data centers. 4 years ago, data center was a 40% business.
Now it's like 75%.
Marvell consolidated its 4 legacy markets, enterprise network, carrier, consumer, and automotive, into a signal segment, a structural acknowledgement that the markets are no longer the story. So we have data centers and everything else.
Yep.
And if we see the breakout there, so data centers are 74%. Everything else is $2 billion. All right. So Marvell's customers are the 4 hyperscalers most aggressively building out AI infrastructure, with a secondary base of enterprises, carriers, and automotive buyers. Hyperscalers: Amazon, Google, Microsoft, Meta.
That's it.
Multi-year co-development programs where Marvell engineers work alongside hyperscalers teams to design custom ASICs for each customer's specific AI architecture. Once a chip enter productions, it ships in volumes across a 3 to 5 year cycle. I bet there are high switching costs once you're built in.
Yeah, well, so I would say it's like a narrow moat that's probably widening because every 3 to 5 years you might need to renegotiate.
Okay. Enterprise and carrier accounts. So these are network equipment makers and telecom deploy 5G infrastructure served primarily through distributors. Remember just a couple of years ago when 5G was a major investing theme?
Yep.
And then automotive OEMs. Okay. So we know the business breakdown. Where does this company operate? So all other regions are half. China is about 36%. The US is only about 14%. I'm guessing a whole bunch of that is just the way that the geography is reported.
Yeah. It's the way the supply chain works.
Obviously, the US is a much bigger percentage than the geography would indicate from there. All right. Business quality questions. How predictable is revenue? Predictable. Right. Custom chips are designed over 2 to 3 years, then ship in volume for 3 to 5 years per cycle. Each generation launches a new revenue stream before the previous one ends. Multi-year production cycle. The DSPs are embedded in rack designs, and legacy systems add variability. Can the company raise prices? Sometimes there's strong pricing power because the switching cost is 2 years of engineering. Standard products like enterprise network switches face real price competition.
But those are becoming less important.
Right. So I would say probably this might be too conservative.
Maybe. I mean, the thing is you got to count on those 4 hyperscalers to keep up their spend.
It cuts both ways.
Yep.
How recession-proof is this company? Semiconductor man is cyclical, and Marvell has proved that. Its revenue declined 7% in 2024 due to the post-pandemic inventory. AI spending dampens, but doesn't eliminate the cycle. So it did fall in 2024. AI spending has really helped that to inflection. So this company's revenue was what, $6 billion in data centers? Isn't like the AI data center spending in like the US alone like 700 billion?
Yes. Yes.
So this is critically important, and it's like 1% of the total.
But it's worth pointing out this is fabless too. So it's like, this is just the brains work. It's not the building work.
And what is their competitive position? Dominant. It's one of 2 companies alongside Broadcom.
Yep.
With proven 3 nanometer custom ASIC design at hyperscale scale. The end-to-end connectivity is unmatched by any single competitor. So there's only 2 players, Marvell and Broadcom, end-to-end portfolio, and small teams outside scopes. 700.
Wow, that's not very
$9 billion in revenue. So okay, well, I now understand
your own opinion there.
Yeah. So I'm just going to call this a 5 out of 5 exciting. For the sake of time, because we're analyzing the stock kind of no matter what. So, okay. Step 2, what phase of the business growth cycle is it in? AI says very clearly in step 4.
It's interesting that it's always in step 4, because if you look in 2022, 2024, 2025, it was negative operating profit. My guess is that it's been paying a dividend the whole time. There
you go. Yep. It's a dividend payer. So we've programmed the AI here that basically if you're paying a dividend consistently, you're pretty much a capital return company. We have more nuance related to stock buybacks because sometimes that's a return of capital. Other time it's just soaking up options dilution. So there is some nuance there, but while operating profits do swing, let's see, 200 million in dividends versus actually the dividend was actually pretty sizable compared to what the company was doing. But look at the operating profits here. Negative, positive, negative, negative, positive, and now
cyclical industry.
Hugely positive.
That's what a cyclical industry looks like.
But look at the revenue. Revenue just like decline. It did decline, but not that much. So these were major investment years.
Yeah, and what you really see is the cyclicality is looking at the revenue numbers won't show it to you. It's the revenue growth numbers that shows you the cyclicality.
Yeah, correct. Either way, when a company is paying a dividend, the call is pretty easy. Revenue is growing, it's profitable, and it's returning capital through buybacks and dividends. This is a capital return company. That's a pretty easy call. All right, next, moat analysis. All right, Marvell holds a wide moat. Multi-year custom chip co-development with top hyperscalers and rare optical DXP expertise at 400 to 800G speeds. So the ASIC is the lock-in. So code development takes 2 to 3 years, and switching means repeating the entire design cycle. The Inphi acquisition brought a rare expertise at the 400 to 800G speeds, and it has a full stack portfolio, custom compute, optical DSPs, and network switching costs. So AI is saying this is a very wide moat company, probably due just to switching costs alone. The moat is widening as data center grew 40 to 74% of revenue. Gross margin recovered to 51%, and the Celestial AI added unmatched photonics. So this is a photonics play as well.
Yeah, that's pretty big deal.
Data center grew from 40% to 74%, focusing the business in its highest moat segment. Photonic bet Celestial AI, $3.25 billion, added chip-to-chip optical interconnects before the market existed at scale.
I'm guessing that's the purchase price.
I'm also guessing that's the purchase price, which is pretty
because
small.
There's no way that 3.25 billion of revenue is coming from there.
Yeah, so this was a play to enter a new market.
Yep.
And then gross margin increased, confirming that pricing power is strengthening over time. All right, well, we already know about the switching costs, the custom silicon that comes. How strong are the brand and IP? 30 years of patents. They have the franchise. They bought the
that optical DSP. That's not something that I was aware of. That's interesting.
There you go. Yeah. So brand and IP, this is more of an IP thing than anything, but in the technology world, I don't think that IP matters a whole lot. Personally, I'm not going to give it too much credit. Is there a cost advantage? They use the same foundries as everyone else. So kind of. And can incumbents copy this? It says kind of. So NVIDIA's primary incentive is selling GPUs rather than custom silicon alternatives. The tension is real, but not extreme enough to be decisive. All right. So with that, we're going to ask the audience to vote here on the size and direction of Marvell's moat. So what is the current size? So this would be a 1. This would be a 5. Let us know the first number, what number you want us to put here. And then for direction, a 1 would be, this company's moat is narrowing. The 5 would be the company's moat is widening. So let us know in the chat. So for example, if you thought thin and growing, you would type in 2, 4.
Yep. So while people are doing that real quick, I'll just say for myself, with moats like this, I need to find out more before I ever give a company a 5 off the bat. I would tend to go with a 3 and a 5 personally. That's where I'm at. I want to find out more about that optical DSP. Some of the responses we're getting are similar to mine. Tim is saying a 4. So broad moat that is stable. Bob says a narrow moat that's growing. So did Mr. Stagg. So did Mark. Jayhawk is saying a broad moat that is growing. So yeah, I'd be between a 3 and a 4 for size and between a 4 and a 5 for the direction.
So I'm tempted to go 4 because what I've seen so far is this is essentially a duopoly.
Yeah.
It seems to be a duopoly at scale. So I like you, I have a hard time giving a company a 5 right out of the gate. Although I understand the rationale for doing so, but the switching costs are definitely huge.
Yeah.
With that, and then the direction is also, I think, growing. So I think 4 and 4 is pretty reasonable.
Yeah,
to go with. Growth analysis. Does this company have growth potential? So revenue grew 42% in 2026 to $8 billion, driven almost entirely by data center. The 4 years of growth masks a 16% business that is accelerating as the AI silicon scales. So its other core business is doing okay as well, but data centers are the engine here.
Yeah.
The Legman said this has a drag. Communications and others have been secular decline for years. Carrier infrastructure alone fell from 1 billion to 338 million. That is a big job. And then margins are inflecting. Now, if we go over to fiscal for a second, we can probably check those segments. Yeah, scroll in. So I know that they just changed this, right? They just said that
yeah, it's all data center now, but
it's basically data center and not data center. Yeah. Okay. So if we do this and then we do data center,
stack them.
Yeah, we might not be able to see the difference huge. I guess you can. You see that?
Yeah. I mean, I think the big thing that we're seeing here is that the green is only growing 3% per year. The blue is growing 40% per year.
That's the difference, right? And you can see how cyclical this business is, right?
Yeah.
1.8 billion, 3.5 billion, 1.6 billion, 2 billion. So this is the legacy low multiple business that Wall Street doesn't really pay attention to. But look at the data center business. Even in 2023 to
It did shrink
2024,
to
it
2024.
did shrink. And then
Yep.
it's really started to grow thereafter. So this business is growing 40% per year. The legacy business is growing 3%. And both are actually fairly lumpy there. But if we go to the overview page on fiscal, I do like to do this and just be like, so what are Wall Street expecting? So Wall Street is expecting revenue growth over the next 2 years to be 43%, earnings growth to be 37% over the next few years. And if you look at estimates and we can see, well, what direction do analysts think the estimates are going? All right.
The green line looks really pretty.
Yeah. So this is the forward for next year, right? Or no, this year.
No, that is for 2028, 2 years into the future.
This is 2028.
Those are estimates.
Estimates. You want to see estimates going
revised.
up. Yep. So this is 2027. So next year. So flat and then going up. Anyway, wow, these are actually gone down at periods of time and now they're going back up. So it looks like analysts are expecting a pretty big inflection point over the next, call it 2 years here. Okay. So is the industry itself growing? The industry is definitely in a bull market right now. No doubt about that. Can new offerings drive growth? So here's an interesting one. Photonic Fabric from the Celestial AI acquisition, automotive Ethernet, and sovereign AI programs each represent distinct growth vectors beyond the current hyperscaler core. So the Photonic acquisition, automotive Ethernet tailwind, vehicle electrification is a play on that. And then sovereign AI. Government-funded AI infrastructure in Europe, Japan, India, and the Middle East needs custom silicon supply chains independent of the U.S. hyperscaler. So definitely some optionality here too. Well, yet again, I don't think we really need to poll the audience.
I disagree with what Stock Simplifier said here. My opinion is different. I think it's high.
Yeah, I also think it's a 5 out of 5. So I think it's giving it an average because the core business is so slow.
Yes. Yeah, it's because the less important stuff has really been a drag. But as time moves forward, it becomes less important.
Side note, this is exactly why we programmed it the way that it did, so that if you disagree with what the AI is suggesting, you get the final call here. So 5 out of 5 is what I'm going to go with. Okay. Up next is management analysis. So we have the founder here. He left in 2016. So he co-founded Marvell with his wife and brother, bringing in history from him, and he departed in 2016. So the co-founder is no longer involved. Matt Murphy. He's been the CEO for 10 years. So he became the CEO in 2016 after 22 years at Maxim Integrated and pivoted the company from consumer into data infrastructure. Good call, Matt.
Yep.
Executed a major acquisitions of Cavium and Infi to build a leading custom AI silicon provider. So he had pretty good. Okay, 4 deals, 0 failures. Each added a technical capability. That is hard to get right.
Well, not only is it hard to get right, but if you go down, it looks like his Glassdoor ratings aren't bad, which is unheard of for a company that's that acquisitive.
Okay, ROC here inflected to 6.8%. So ROIC is going to be, okay, acquisition goodwill depressed the ratio, but free cash flow margins reached 17%. This is why you need to understand the nuances of accounting. So return on invested capital is a good metric to judge companies that are in phase 4 capital return. However, there can be accounting nuances, in this case, acquisition goodwill, that can distort that figure. So while it says 7%, I'm guessing the real number is actually much higher than that. All right. What do employees think? Review sites show 4.3 out of 5 with 90% recommending. This is a great place to work. Cool. Do they beat expectations? Yes. They've beat earnings expectations in 7 of the late 8 quarter, and the one miss was just 1 cent below, and EPS as data center 3x'd in total. So they have a strong record of execution. Are they shareholder friendly? Their buybacks are growing, but the diluted share count still rose.
Those acquisitions have to be part of that.
Oh, okay.
So I'm willing to give a pass there, or at least an asterisk.
and the return on invested capital. So we've programmed Stock Simplifier that the metric for judging management changes depending on the phase that it's in. In a phase 4, again, return on invested capital is technically the primary one to look at, but it's being impacted by those acquisitions. So I'm also going to say, okay, tons of goodwill. It's really free cash flow here that tells the story. And if we go down, we should be able to see the history here. So it looks like they missed twice out of the last 8. All right. What do you think, Stoffel? How would you rate the company's management here?
Good to great.
I'll go with great.
I mean, 4 acquisitions and pulling that off is pretty impressive.
4 acquisitions and good ratings from employees is like
it's unheard of.
Extremely hard. Plus, he pivoted the business to the correct sector 10 years ago to kind of set them up the way that they are now. So I like this CEO. I like this management team.
Yeah.
Up next is going to be risk. So we'll have the viewers vote here on the risk here. So execution risk. Most risk traced to 2 factors: near total dependence on AI data center spending.
Cuts both ways.
And 36% China exposure. A strong balance sheet with low leverage provides some resilience. So as goes AI spending, goes revenue, and goes this stock. Yeah, as goes AI spending, goes estimates. As goes estimates, goes this stock.
Another way of saying it is, what really matters is when Meta, Microsoft, Amazon, and Google, when they report Q3 and Q4 earnings, and the analysts ask the question, what's your CapEx spending going to be next year? Over the short term, that's everything for Marvell stock.
Yep, absolutely. So this is a stock that's going to hinge on those 4 CEOs' words.
Yep.
That's what I would call an outside force.
Yes.
China geopolitical risk. China is 36% of revenue, and U.S. with tight controls. A permanent 50% reduction in China revenue will remove about 1.5 billion in annual revenue from the base. Yep. So geopolitical stuff here to worry about. And then balance sheet. The balance sheet, though, is very strong. 1.4 billion in free cash flow to provide them through with downturns. So revenue diversification is terrible. Right? 4 companies make up a huge portion of the revenue. Is disruption of threat? Okay, this says some risk. AI architecture evolves faster than prior semiconductor cycles. Hyperscalers have the economics to bring chip design in-house. And Google
and we know
already doing this.
We know already that Amazon already does that.
These companies are spending so much, it makes sense for them to de-risk their own businesses.
Right.
How much is outside of their control? Some is definitely outside of their control. And then finally, how healthy are the financials? So offsetting all of those are the financials, which are extremely strong. But all right, I do want your viewer opinion on this one. Where would you rate Marvell's risk profile? 1, very high. 5, very low. And while we wait for that to come in, let's take a look at the concentration in particular. 74%. The vast majority is programs with 4 hyperscalers. Does not disclose customer level revenue. It's likely that 2 or 3 of these represent over 50% of company revenue. I mean,
yeah,
that's
it's a lot.
That cuts both ways, right?
Yep. It means your sales and marketing budget doesn't have to be that big.
It does not. Well, it does not. When
you only got 4 different addresses that you got to send someone to.
What to watch? China. Hyperscaler CapEx commentary is the leading indicator for revenue risk. Hyperscaler CapEx commentary. So
you know, exactly. I like this last one. This shows me that Stock Simplifier is really learning, because that's some scuttlebutt right there.
Watch for job postings and executive hiring in custom silicon at AWS, Microsoft, and Meta. So that's a really interesting insight there. If you see job posting related to custom silicon, that could indicate
it's like checking the parking lot to see what you should invest in.
That really is good call there, Stock Simplifier.
So
what do people say here?
The average is between a 2 and a 3. I would give it a 2. Personally,
I also would give it a 2. Customer concentration is a big deal. Like Marvell definitely has a good moat, but Broadcom exists. So. Right.
Well, and in-house exists.
In-house exists. Yep. And that's I think that's what qualified as a disruption risk, right? The disruption wasn't necessarily an outside player coming in.
No, it's still a duopoly. It's
insourcing.
They have economic incentive to go in-house. It's hard. It's a pain in the butt, but they do have some economic incentive.
Valuation time. I'm sure this is going to be very interesting to look at.
Yeah.
Okay, they trade at a very expensive. The PE is 78, well above its historic trading range, and its dividend yield is also 0.1%. So trailing numbers look bad. So DE, price to earnings ratio, this is a company that trades normally in the high 20s, low 30s, currently 78. If we look at price to free cash flow, this number is all over the map. It got down as low as 29 times, currently 150 times free cash flow. That could be related to just general investments in the business.
Yeah.
If you look at price to operating cash flow, similar story. Price to operating cash flow is really high. Dividend yields got as high as, almost 0.6%. Now it's 0. Shareholder yields, which includes buybacks, price to book, price to sales, 25 times sales, and almost 50 times price to gross profit. This might be a good one to do a reverse DCF on.
Yeah. So I've actually gone ahead and done that. So, but here's the thing is figuring out what is the optimized free cash flow margin. I don't know if you're willing to go real quick on fiscal and just pull up their historical free cash flow margins.
Okay.
I'll tell you what I input, but I just think it's worth just peeking at what have those margins been at in the past. And so what you'll see is, so here's the thing.
As high as 24%, as low as,
you can probably pull that back
10%.
even more too. But I'll just say, I was super aggressive, Brian, super aggressive. I gave it a 30%, which, you know what, now that I'm looking at it, that was probably too aggressive, but this will drive the point home. Even with a 30% free cash flow margin, which they've never hit on an annual basis, they need to grow 25% per year for 10 years to justify this stock price. Now they're expected to grow at 40%-ish over the next 3 years. If they hit that, they still need to grow at about 19% per year in years 4 through 10. And their long-term average growth rate, is 7%.
Okay.
Now, we are at a once-in-a-lifetime build-out, too, and you got to take that into consideration.
So that's important. So Stoffel did a reverse DCF, which, by the way, we're building this tool into Stock Simplifier. It's just not available as of yet.
Really good. I started using it yesterday.
So he did a split. Split growth reverse DCF. So over the next 3 years, 2 years, you assume what? So
I gave them 40% per year revenue growth.
So assume 40% revenue growth over the next 3 years and assume a 30% free cash flow margin.
Yep.
Then what's the growth rate from years 4 to year 10? And the answer was 19%. So 40% growth for the next 3 years, followed by 19%. And this is revenue growth, mind you.
Yeah. And they've got to hit free cash flow margins that they've never hit before. Now, it is a different business. They've done 4 acquisitions.
Different business.
So.
And I think this is a company.
I think I was probably too aggressive on that.
I think this is a company that's doing gross margins in the 50s, low 50s.
Yeah.
Actually, that's a pretty stable gross margin for considering this business. This is a business with, it got to the 60s.
It's fabulous. That's the thing. When it's fabulous, the gross margins don't. When it's fabulous and you are very slim on your staffing.
I don't think the assumption you put in is outrageous, because if the company can get its gross margin back up to 60, and a whole bunch of scale that's built into the business can help it get there.
It could hit 30. It could.
Yeah, I think it could hit 30. So,
it's aggressive though. It's an aggressive assumption.
Either way, I don't think there's any way. Well, this will put out to the vote. Let us know in the chat how you would rate Marvell Technology's valuation today. So clearly, all of the multiples, at least the trailing multiples, say high. Let's look at forward multiples too, just for the sake of completeness.
Yeah, well, folks vote on this.
Yeah. So ratios.
Mm-hmm.
And if we go, instead of trailing multiples, we'll use forwards. So forward PE.
55. It's still up there.
55 times next year's earnings, but those earnings are likely to grow extremely fast. So 55 times, just at the earlier part of this year, this is a 20 PE business. And if we put the mid-year on that, although this is just a completely transformed business, right? So it's probably not fair to look at back that far.
I mean, it's still well above its average.
Yeah. That's forward PE. I have a feeling that forward priced operating cash flow and forward priced to free cash flow, they're all showing basically similar things. Anyway, what are people saying?
Well, we got 1.6, but everyone else is between a 1 and a 2. I would be at a 1.5.
All right.
Where are you?
I'm on the 2. I'm
okay.
a 2. I'm a 2 here. I'm not a when a business has a ton of momentum, this business has a ton of momentum, and a stock has a ton of momentum. This stock has a ton of momentum. I tend to be a little more lenient with valuation than I do otherwise. And when you mix in the that they've exceeded expectations, this is not a cheap stock. No way, no how. But I wouldn't call it insanely expensive. I would just call it expensive, personally. All right, so there we go. So overall, we view this as a 5 out of 5 exciting business that's in the capital return phase. The moat is wide. We rated it as broad. The moat direction is growing. We might be underrating that.
We might be. It takes more. I need more research.
The growth here, especially in the next couple of years, is extremely high. This is a great management team. The downsides here was that the risk level was very high, concentration risk, geopolitical risk being the biggest problems, and the valuation, we were debating between a 1, horrible, and 2, quite expensive. This to me is a classic watch list stock, right? Yep. Business looks good. Risks and valuation don't look great. This is a company that I want to keep track of, but not buy immediately. But as a reminder, Jensen said that this was going to be $1 trillion company, and the company today is only $200 billion.
We had someone pretty much say the same thing, that they would buy it at 190. Right now it's at about 230. So that would be a drop of, I don't know, 15, 20% ish.
Yep.
Just to put that in perspective.
So for everyone that has watched, we've been using Stock Simplifier to do all this analysis. We hope you see how easy it is to analyze stocks fundamentally using Stock Simplifier. We do have 2 ways you can get started with Stock Simplifier. We have the standard plan, which includes all of the analysis we did with the flip cards. We also have a deep dive plan for people that want reverse discounted cash flow calculators and to go deep into the analysis. Now, with the standard plan, we do offer a 10% discount for our YouTube viewers, and you can get a 7-day free trial. So you can start analyzing stocks using Stock Simplifier completely for free for 7 days. And we'll put a 10% discount in there too if you decide to stick with it for the long term. So Stoffel, if you could share a link so that people that are interested in getting started with Stock Simplifier can do so. Again, it's a 7-day free trial. Kick the tires. You do not have to commit to it or anything like that. But we think that once you research stocks this way, you will not want to go back to doing it any other way. So this stock is now on my watch list. Here's the date for it, and we can go back and see. Here's all the notes that we took and all the valuation work that we came to it on it. All right. Well, thank you. It is a must buy, says Tim. Well, hey, there's opinions out there. We just try and do the research, give you our opinion, and you are free to draw your own conclusion. Thank you guys so much for joining us today. We hope that you enjoyed this session. We will be back next week to analyze another stock completely from scratch. Wishing you guys investing.
Probably a stock that's done very well that we don't own, which has been our MO.
That's exactly right. All right. Thanks, everybody. Have a great day.
Bye, everyone.